Today I want to analyze Starbucks. It's the biggest coffee chain in the world, selling many popular products. So we can see here in the 1 year chart, we are up around 7%. We had a strong comeback from July. We are up close to 35% from this time. So this is a very good performance. Overall, in the last 5 years, up around 70%. We're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is the huge market cap of 111.6 billion US dollar. This makes Starbucks the sixth biggest beverage company in the world. We also have a dividend yield of around 2.46%, which we can see here had a good growth in the last 5 years as well. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here the revenue in 2020 was around 23.5 billion US dollar. This was an 11% decrease from 2019, so probably related to COVID. Then we had a 22% increase in 2021, very strong growth. Then around 11% increase in 2022. Then again 11% increase in 2023, and then around 0.5% increase in 2024. So overall it's a check here. We had the good revenue growth in the last 5 years, but we also can see now the revenue growth in 2024 is slowing down, so we don't really like to see that as well. The next thing we're looking for is free cash flow growth in the last 5 years, a very important number because the free cash flow can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we can see in 2020 the free cash flow was around 0.1 billion US dollar. This was a 96% decrease from 2019. So this was the reason because of COVID. Then we had a strong recovery in 2021 with around 3,850% increase. Then we had the 43% decrease in 2022, then the 43% increase in 2023, and then the 10% decrease in 2024. So overall, the free cash flow growth is very inconsistent. We had some strong years and we had the negative years again. And if we take the number from 2019, it was around 3.2 billion US dollar. So overall, we had the low free cash flow growth in the last 5 years. So it's still a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also indicate the valuation of this company. If it's under 4%, it could indicate an overvaluation. So what we're going to do now, we're going to take the free cash flow in 2024. So this is around 3.3 billion US dollar. Then we're going to divide it with the current market cap of 111.6 billion US dollar. And then we're going to get the free cash flow yield for 2024. So the number we get is around 2.95%. So overall, this is not a great number, I would say. It's under 4%, so it's not a check here. And this can also indicate an overvaluation. And again, if we take the dividend yield around 2.46%, this means the company can pay the dividend with the free cash flow yield, but they pay a lot of money from this free cash flow. So I think it's not really good to see because they also need to have a free cash flow left to invest in the business and also to pay back the debt. So we don't really like to see the high payout ratio like this. So with the current free cash flow yield, this company looks overvalued to me, but I think we should also make some assumptions that they can increase the free cash flow as well. So if we ask ChatGPT, in 2025, the free cash flow could be around 3.5 billion US dollar, in 2026 around 4 billion US dollar, and in 2027 around 4.7 billion US dollar. So overall, I think we should assume around 4.5 billion US dollar in 2027. So if we're going to divide it with the current market cap of around 111.6 billion, then we would get the free cash flow yield for 2007, and this would be around 4%. So overall, I think it's still not a very high number. It can still mean the company would be overvalued. But of course, if the free cash flow can continue to grow in the next years, this company can still be in a good valuation right now. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take the long-term debt here. First, exclude the capitalized leases. I think this makes more sense. So this is around 14.3 billion. Then we're going to add the short-term debt as well. This is around 1.4 billion. Then we're going to divide it with a current free cash flow of around 3.3 billion. And then we're going to get the ratio. So the number we get is around 4.75. This means in close to 5 years, we can repay the debt with the free cash flow. So I think it's a good number. It's not a great number, but it's a check here. We can also take a look on the cash on hand. So how much money this company has in the bank. And we can see here, they have around 3.5 billion US dollar. So this is also a good number, I would say. So it's quite a good balance sheet. The next thing we're looking for is the enterprise value to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first we're going to get the enterprise value. This is the current market cap of around 111.6 billion. Then we're going to add the debt as well. So the debt is around 15.7. Then we're going to take minus the cash. So this is around 3.5 billion. And then we're going to get the enterprise valuation. So the number we get is around 123.8. So this is a valuation of the company. Then we're going to divide it with the current free cash flow. So this is around 3.3. And then we're going to get the enterprise valuation to free cash flow ratio. So the number we get is around 37.5. So I think this can already indicate the overvaluation of this company. Now, if we also use the assumption in the future that the free cash flow could be around 4.5 billion US dollar, so we can calculate this quickly as well. So we're just going to change the free cash flow. The enterprise valuation would be the same right now. So if we do this right now, we would get a different number. The number we get would be around 27.5. So this number looks already better. It's because the free cash flow is increasing, but I still would say this number looks quite high. So it's not really an undervaluation right now, even if the free cash flow would increase in 2027. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look here, and what we can see is this company is buying back a lot of the shares, especially in 2023 and also in 2021. So I think it's something we need to consider as well, if they're buying back their shares in a cheap price or in an expensive price. So I think in 2023 and also in 2021, the company was probably quite high in the price. So the stock price was quite high. So I think it didn't really make sense to buy back a lot of shares at this time. It makes more sense to buy back the shares if the company is undervalued. So overall, it's still a check here. They have buybacks. We like to see that. But I think the management need to choose a good time to buy back their own shares. I would like to give my conclusion about this company, so let's start with the positive. So I think we had some good revenue growth in the last 5 years. We also had some free cash flow growth, but it was quite inconsistent. Sometimes we had a decline, sometimes we had some growth. We also have a good balance sheet, I would say, low amount of debt and good amount of cash on hand. I think the valuation is quite high. We have the free cash flow yield around 2.95%, which can indicate the overvaluation, and also the enterprise valuation to free cash flow ratio around 37.5 indicates an overvaluation again. And also with the future assumptions that they can increase the free cash flow, I still think this company looks overvalued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.